We are, exactly. We have an act. We need to take it on the road.
Okay, so good afternoon. We're heading into the home stretch here, and my name is Howie Cohen. And first of all, I want to thank Marty for putting together this incredible event. And I think he deserves a round of applause because he just works. I don't know if any of you have noticed his emails that come through at 4 a.m. and then that night at 2 a.m. So I don't know how he does it. Suzanne, the most hardworking person in the room today. Pete Thurlow for hosting this event and the new space that we have, and all the previous panels. It was a great day, and I hope we can contribute to it, even make it even better. So quickly, my name is Howie Cohen, and I'm an advisor with Strategies for Wealth, and I focus my business on working with entrepreneurs, business owners, high net worth families, and family offices on tax strategy, wealth preservation, and multi-generational dynasty planning. I'm going to let each one of the panelists introduce themselves, set a few ground rules, which is I want to hear from everybody, and let's have a lively conversation. And if anybody from the audience has a question, please raise your hand. And if I don't see you, call out and say, I have a question. We'll start with Suzanne.
Well, I'm not going to take too much time because I think you've all seen enough of me today. You're probably like, what's that blonde doing up there again? But for the purposes of this discussion, I've spent a great deal of my career on the credit side of things, going back to, I'll date myself, starting at Drexel Burnham, but the firm that my day job, as I call it, when I'm not de facto working for Marty, I work for a firm called Lampy Conway, where the principals had a fund in the lower middle market, special situations, stressed and distressed space for a number of years. They then became a family office and were looking to launch that product again. So very credit focused. And I look forward to the discussion. And then I also co-host, as you know, the Resilient Alpha podcast. But please tell your family, tell your friends, right? Spotify, YouTube, our webpage, resilient-alpha.com. We work hard at putting these things together. I mean, it looks like we just came up with these questions, but there's a lot of preparation and we want everyone to learn from what we talked about.
Andy?
So I've been a buy-side so-called professional investor for 40 years, 25 in the family office world, 15 in the institutional world. From a credit standpoint, I would say the first 20 years was completely ensconced in Swiss Palm Beach, New York family offices, and we didn't do credit, so I'll leave that out. I went to State Street in 2004. I built and ran a global fund of hedge funds. We invested in 26 countries, 6 fund of funds that were all combined. The biggest and most successful fund of fund was credit. And I think just to set the stage, actually I have something really boring to set the stage when we get to it. But I think in that experience of investing all around the world in every kind of credit you can imagine, we even did direct lending back in 2012, aircraft even before. But my point is that, and this is to you folks to ask questions, the one thing in credit versus a lot of other strategies, the tools that are available, the opportunity sets that are microscopic or macro are really, really varied. And I think that's in a fund of hedge fund context. That's what made us able to do such a good job, was having the flexibility to access so many different opportunity sets.
Joel?
And I would just add to what you said that credit is also different than the equity side. Equity people tend to be glass half full. Credit people tend to be glass half empty.
Hi, I'm Joel. I'm the third member of this panel.
Win in a minute.
Eventually.
That is an important point, though.
We've learned in this panel the best way to operate is just cut in.
Hi, I'm Joel. I've been in credit pretty much my entire professional life. I started out as what in the UK we call an insolvency practitioner, bankruptcy trustee over here. Ran a litigation fund for family office, advised family office, families in the UK on a whole load of assets, primarily credit, but other stuff as well. And have been involved in on the credit side, opportunistic macro credit, so public market stuff. We've got some interesting South American things going on. And then in lending, we have historically done a lot of sort of middle market lending. I think we're probably going to we're winding that back a bit. We can talk about financial conditions on that. So yeah.
Great. So when I was preparing for this panel, where did I go? I went to ChatGPT and said, what are credit strategies? And in less than 10 seconds, I found out all about this. So I
Oh yeah.
Oh my God.
so I can just
So why didn't we just put a computer up here and you can ask the bot.
Howard,
You don't need us.
Just email them to everybody in the audience.
Yeah,
We don't need to do
exactly
One-liners.
exactly the point. So
So Howard, before you start, I wanted to add something Suzanne was just saying, which wasn't an introduction. So I want to say the stupidest thing we're going to say in this whole panel, because there's been so
Are you
many.
sure?
Yeah, I'm sure, because there's been so many panels before. Equity people think about how much money they can make, right? Credit people think about how am I going to get paid back? And I know it sounds stupid, but it's a really different mindset. So we talk about all this stuff. Don't listen to the venture guys and the private equity guys and everybody else. This is a credit panel.
And I'll just echo that one step more. When I was a partner of a fund called Claren Road, which was a long, short, liquid credit fund, we were pretty good at picking individual names, both on the long and the short side. And we had a client come and said, well, you're so good at picking names. Why don't you start an equity fund alongside? And I remember the main partner saying to the client, you don't understand. We think totally differently than equity people. We are good at figuring out how to pick credits. We don't pick equities.
So Suzanne, what do you see as the biggest opportunities right now in the credit world?
Well, credit broadly. I think that there is going to be real opportunity in the space that we're involved in at Lampy Conway, because finally some chickens are coming home to roost. And while public default rates still seem like they're non-existent, we're starting to see it more in the private world, and that's going to translate into the public world. It's just going to take a little bit longer. We focus on small cap companies, and those tend to be underloved, underfollowed, underpaid attention to, don't have the same ability to kick the can down the road than maybe their larger brethren. So I do think there's great opportunity there. I think private credit remains interesting, but there's so many potential minefields and so much bad underwriting. I wouldn't want, without having somebody who could do the work to really know what's in an underlying portfolio, I wouldn't want to buy a secondary in a private credit fund, for example. A guy who's coming to that space and, raising a new fund with a new balance sheet, that's a different animal. I think real estate lending is very interesting. I don't know that I believe that real estate as an asset here is that interesting, but real estate lending, I think there's a lot of opportunity. There's a guy that we did a podcast episode with who left MSD, which is Michael Dell's family office, and just launched his own fund, first close $1.8 billion, called Derby Lane. I think he's going to kill it based on the things he's looking at. So I would say those are a couple of areas. And I would just also caution people to remember when they're looking at credit, I often get asked at certain family office conferences, come on a credit panel. And it's like 4 real estate guys and me. And they're all talking about the returns that they can get. They're levered, right? When I look at credit, leverage is a big part of the underlying thing. So at Lampy Conway, we don't lever our portfolio as a way to generate returns, because we feel like the businesses we're investing in are levered enough. But I just think it's something that everyone needs to keep in mind when they're investing in credit products, is what the leverage is. Because oftentimes you've got a levered asset to begin with. And then if you're
an implicit leverage, you can know that.
Joel,
well, no,
do you
implicit leverage, but I'm saying
I don't think it's a difference. Explicit leverage.
correct.
I just do you want to just expand a little bit on the leverage side? The issue that I generally say with that, the issue I generally find with the real estate is, and there's always the thing with the real estate lender, is the one thing you care about is quality of underlying asset. And the underlying asset is barring, and I have seen things where people have out and out lied, but generally, you know where the asset is. You can go there, you can see it. Well, but then you get lower interest rates. So this is always the trade-off. So if you want to go and basically be a bank and go lend at 2+, 2+ the Fed rate, go have fun. Better be big. It's going to be very boring. And sure, it's better. I mean, well, the problem boring is better in credit, yeah. But bear in mind, inflation is starting to kill you. So this is the fight, which is the fight credit's been having the last few years, which is credit. The inflation means that these, more quote unquote secure loans are underwater.
But when I'm talking about the leverage that's implicit, and I mean, I do think when you're lending on real estate assets in general, to your point, they're tangible. You can see them. You know what the value is. So you can take leverage that you might not take in other asset classes. You just have to, if you're hiring a manager to do it, for example, you want to know what kind of leverage are they using? What rates are they getting? How many turns are they using? A guy who's telling you, well, I'm doing, 12% net and I'm lending on A-class properties in New York, Dallas, Miami, is that guy could be doing it with 3 turns of leverage and somebody else is doing it with 2. So it's understanding the nature of that quote net return.
So I want to take a step back because we're in the weeds already, and which is fine. That's where we want to get to. But 2017, I left the institutional world. I'm running a global fund of hedge funds. Rates are 0, defaults are 0, volatility is 0. We were 9.5% CLO, triple B, and double B, which is a stupid way to run a fund of fund. It's the only way to make money. There's nothing to do. No defaults, no nothing. Okay. So when that situation is there, take risk, maximize your return. By the way, high yield was only 5%. So you had to take more risk than high yield debt. Okay. Now let's move forward to today. Okay. It's not that world anymore. Okay. It's a world where, although Suzanne said they're starting, actually have data from lower middle market where you could already see them ticking up. Let me explain why. So first of all, I'm just going to quote somebody because then it's better not coming from me. So on a call about a month ago, a small group call with John Zito. John Zito is co-head of credit at Apollo. He's head of credit at Apollo and co-head of asset management. Okay. Not exactly a small position. John said, and by the way, they own an insurance company too. So John said, we are moving everything. And now that we're leaving the stressed out of this for a second. This is their, big portfolio. We are moving everything to secure debt, whether it's senior secured loans or whether it's bonds, whatever it's secure debt.
They're going up the cap stack.
So wait, so now there's what we're talking about too. I want to bifurcate this for our conversation. So she's talking about defaults increase. I want to get to that in 1 second. So in 17, you wanted those risky debt because that's where your return was and the defaults were 0. And by the way, there was a company back then that was a week from bankruptcy. They'd already filed, got $100 million refi and bailed out and canceled the bankruptcy. That is absurd. That will not happen today. It's not happening today. We'll be in bankruptcy. So what I'm trying to say is that think about today, not about what was, because today is an environment that is very quickly evolving in credit. You take John Zito's approach, or the other side is it's already happened in commercial real estate debt, CMBS breaking down and things like that. You can go with and what her firm does well, which is to go with messy stuff, get it cheap, fix it up, get it right. This is just buying cheap assets. It's hard work.
I would say it's a little differently. It's value with a
okay,
catalyst because cheap sometimes stays
I shouldn't
cheap.
talk too much for your firm because we were invested in many, many different strategies that did this. My point for you folks is don't go down Main Street. Whatever you own on Main Street in credit, listen to John Zito. Either go that way or go with what probably Joel's very good at, and I'll let him talk about it, is find more complicated situations where you can extract value. But get out of Park Avenue.
I think this is to the point of where credit's heading, and the drums have been the drungle drums have been going for a while. 2 years ago, all the mid-market restructuring guys were saying, nothing's going on, we're all very bored. You went to a real estate thing and they were like, oh my God, it's every day, we're all going bust, we're all losing our shirts, we're trading the debt again and again and again, and the values are dropping, and where's our security? Is there any security? What do we do? Move forward, we see the lower middle market, we're seeing an uptick in receiverships, which you never saw quite as much of. So people can't afford to go into Chapter 11. There's so little assets left in some of this stuff at the lower middle end. So that's a scary place to be. You start seeing UUC PGs, which are it's real bottom of the barrel stuff. It's not, they are opportunities. They're not necessarily opportunities that make you very popular, but they're opportunities. They can be very lucrative. But the amount of these are situations which are very messy, and it's under the radar, and it's understanding, it's getting into the weeds on these. It can be and it's finding the transaction that's the right size for your office. And I think that's where the issue is. As you go up the stack, so we've started to see the big Chapter 11 start to happen. So that's sort of happening. It started this first half of this year. It's only time. Then you start getting into your like Apollo fun. Where are we on the cap stack? Can I be the fulcrum? Shall we do some dip financing? And we can play all sorts of interesting acronym debt tennis.
So you can look at it as the haves and have-nots. You know why NASDAQ's making new highs? Those people have no debt. In fact, when interest rates went from 0 to 5, Apple's earnings shot through the roof. They have so much cash, right? But the have-nots, remember I said high yield was 5%? Those are the worst credits in the public market out there, 5%. So what happened is they're 5 to 7 year debt. They don't all come due in 1 week. So how do we look at defaults? When you're looking at defaults, you're looking at history. How can we look forward, or at least today, to the next year? Very simple. That 5 to 7 year debt, when it rolled, first of all, it stopped in the pandemic, so nothing got refied. First quarter of 23, high yield came back. You know what the number was? 8.5%. So you are a middle market company, and maybe you're not doing so great, and your debt service just went up 40% in an afternoon. So this is a slow rolling process. It's not a 2008, everything falls apart. It's one piece at a time.
And I'm just going to say this because I think if the one thing, the sort of elephant in the room that none of us have mentioned is the Federal Reserve. Because unless they're dropping 200 basis points, nothing is that is not enough to affect this market. It's too big. It's been rolling down the hill for the time it's been rolling down the hill, and there isn't enough. The Federal Reserve, these are not, they could do something, but there would be a bigger cut than I think they would be contemplating at the present time. For that, in the short term, but I just don't think in terms. Yes, short term debt. It's not long term, and to be fair, it's rates that people only in the very low risk market are approaching. If you're in that low middle income area, I assure you, the 25 basis point that the Fed decides to take off at the next meeting, if they decide to take off 25 basis points, ain't going to save you. If you're not in a position, if you're not okay now, it ain't going to save you.
And I think I would add to that you have to be really conscious of the fact that, yes, there's all of this money chasing private credit and making private loans, but the traditional lenders to these smaller companies that have the issues that we're talking about, like the middle market banks, aren't lending. And even when you cutting rates actually incentivizes them less to lend. So there's less capital available for small companies, in particular, to Andy's point of the have-nots.
Well, it's the cost of it. 2017, the 10-year hit down to 1.32. People were getting 2.2% mortgages. You guys probably all know what the mortgage market is today, right? So whether it's private lending, whether it's a bank, whether it's high yield, they don't live in different universes, right? You're lending to a universe of people that have to pay you back. I said that at the beginning.
By the way, that's why I like real estate lending.
So it's like
Now.
there are differences, but they're not in a different planet. Okay. So when the cost of debt service goes up, it goes up for everybody. But the thing about the Fed I want to separate is I just said high yield, 5 to 7 years, mortgages, 30 years. Those are driven off 10-year much more than driven off Fed funds rate. So the 10-year has been in the 4s for years now. Mortgages have been at 7% 40 years now. So if the Fed cuts rates 2%, it's only affecting a small subset of that universe. And the only thing that got the 10-year down is the Fed started buying those bonds, but their balance sheet has gone from 9 trillion to 7 trillion and it's heading down. So they're not buying anything. That's the only thing that would change that game.
So I want to move a little to, and we had a very spirited conversation in our prep meeting as well. Joel, you spoke about the work that you do with distressed markets, and so just give a little insight into that.
So distress, I mean, so the distressed world is distressed credit in some ways it's still credit. So you're still looking at defined outcome because
It's equity and drag, though.
can be. It depends on where you are. So
Owning the company.
you can do, and sometimes that's a really nice place to be. Sometimes it's a great place to be. What you tend to end up with is a multiplicity of tools, and everything is very situationally, everything's very much dependent on the given situation. And sometimes you'll do really well, sometimes you won't. A lot of it will depend. So where you can be, so sort of in some ways, the easiest way to play it is if you're right at the top of the cap stack. So senior debt in a big chapter 11 almost never gets touched, but tends to end up priced
80% recovery rate.
exactly. So you tend to end up with very good value on your very senior debt. Then you start dropping down into the intermediate stages. You hit a point where you're what's called the fulcrum in restructuring. So you're the class of debt that can approve the chapter 11.
That's where we like to play.
And that is the best place you can possibly be. And that is where your Apollos and Lampy Conways and your specialist firms, and that's the game that they're playing. And then if you find yourself in there, can you dominate the class? What can you do? What can you do with the plan? And you have vast quantities, and there's a lot of tools, and there's lots you can read about it. Not really necessary for the purposes of this conversation. You have a hell of a lot of tools, and you have a hell of a lot of power for what is often a fairly highly discounted debt prior to the event. And the question is, where on that day that the bankruptcy happens, which debt class is going to be?
Well,
Tell them how it got there. Tell them how it got there. How did it get to what you just said? What happened?
Well, the
people that Joel, no, this is for Joel. Don't put the mic down. So you owned this debt and everything was fine. You're getting paid every quarter. Everything's good.
Well, we buy it. We're hoping everything's
You bought it after. This is what I'm trying.
We buy it before.
They're buying it before the chapter 11. That's the whole point of the game.
No, but give me 1 second here. So remember I said, don't stay in the middle. I said, because those are the companies that these two people will be going, chapter 11. Wow. Let's look at that thing. But if you owned it before it got to chapter 11.
Let me just clarify a little bit about what we try to do, particularly because it's relevant to the lower middle market. But I want to back up for a minute and just say, like, these situations, and I agree with Joel, are very interesting and you can make a lot of money, but you have to be careful at the way you go about it and make sure that you have people who are very familiar and intimately knowledgeable about the bankruptcy and restructuring process. Because one of the things we talked about on our call, particularly in private credit going bad, a lot of the people who've underwritten this private credit don't know how to work out anything. And it's going to be very problematic for those firms. But we'll buy a small position in something at 70 cents on the dollar, right? Because bonds don't tend to stay at 70. They either get pulled to par or they get hammered. And so we'll buy small positions, and some percentage of the time everything goes right and we get pulled to par and we have a nice trade. Some percentage of the time we get under the covers and do the work, decide that there's no there, the business is a melting ice cube, management's delusional. And then there's another percentage of the time where we want something bad to happen. And when that something bad happens, and as you said, people who have owned it, that's when we want to buy. That's why that's when we want to buy more. And we will take larger, more concentrated positions. However, we want to be in that fulcrum, but we don't, to the extent that we can stay off, want to be on the committee. Because once you're on the committee that, quote, approves or doesn't approve the bankruptcy, you are restricted. You cannot, you find out there's fraud, you find out there's something you don't like, you're stuck. So we like to be big enough in the fulcrum to have leverage over the process without restricting ourselves or our investors. Because it happened to us once, right? We were involved in a company that was a roll-up of driving ranges. And we were the most sophisticated credit investors in the cap stack, and we got begged to go on the creditors committee. 2 days later, Steve Lampy finds out the CFO is committing fraud. We're stuck. You're a donut and it's fraud and you're screwed. If you are, can have influence and leverage and work with the people who are on the creditors committee, that's a better place to be.
So I didn't want anybody to sound like, by the way, when I said I ran a credit fund, this is a fund of hedge funds.
A manager of manager.
No, but all credit hedge funds. So we did The Big Short like the movie, except without the drama. Okay, no drama, no hookers, no nothing. We did that trade. So we were short high yield. I mean, so this is I was just trying to get them to talk about these situations in the context of an audience. That's all. This was my bread and butter, was hiring. By the way, I was invested in Claren Road before you got hired, if you remember.
I do remember
Yes,
that.
we were already invested there. So this is not me throwing shade. I was trying to get them to elucidate what this is. By the way, we bought a busted double ETC. Forget what it is. This is what happened. We owned 6 airplanes in the desert. We parted out the airplanes, sold the engines, and made money. Now, when I say we invested in somebody who's really good at doing it. And this is what Suzanne's talking about. We don't want to be on the creditor committee because we're restricted. These are people that really know what they're doing in very specialized areas.
And to that point, if you are an investor in credit, there are the two ways to look, as Andy's saying, is you go up or you go all the way to the top and you go right to secure, highest possible credit. Okay, it's going to hit my returns, but you know what? I can sleep at night. I don't need to worry about it. I can go play golf. I can go play tennis, and I don't need to think about it. Or you can do right to the bottom, and I'm seeing a lot of stuff at the bottom. There's a lot of opportunity in things like factoring agreements. There's a lot of companies under pressure. Factoring agreements, very interesting way of taking advantage of credit. Invoice financing, forms of invoice financing, becoming increasingly popular here. They've been popular in the UK for a while. Seeing things like MCA agreements, really quite tough pills for small, medium companies to swallow, but they're having to swallow them, simply because the margins are just getting so tight. And those are, you have a lot of, as a lender, you have a lot of power over the company. You have the ability to really go in, do your DD, take a view on what there is. If you want to take personal guarantees against people's houses, that will be open to you. They're not going to be in much of a position to fight you on a lot of these terms. I leave that between you and your conscience, but that is the situation which I'm seeing in the lower middle market in terms of the non-distress. This is just fresh lending. The opportunities open are there, and they're not things they're certainly not things that are sexy. They're certainly not things that one likes to brag about at the country club, but they are there. They do give very solid returns. You can protect yourself pretty well down the line. You accept a default rate, and it is just simply the cost of doing business.
In terms of comment of crisis of conscience, or it's your own conscience. As Gordon Gekko famously said, you want a friend, get a dog, right? We're in this business to make money, and if the person on the other side is sophisticated, no, but what I was just going to say is, when you're getting involved in this stuff, it's messy, and you have to remember. I mean, you started out as a bankruptcy attorney, so you're in the weeds on this stuff. We are living in a generation. There's a generation of investment professionals that have not seen distressed. Right? Because we haven't really had distressed post the financial crisis.
It was the last time.
2011, so 14 years, right? So there's a whole generation of people that have been underwriting private credit that have never seen distressed. There was a 2-minute moment during COVID, right? The falling knife trade, which lasted like 8 seconds, and nobody really was able to put any money out. So if you're investing with managers, and I think I've said before, out of our family office, we invest in other managers. You want people who have done this before. And unlike other parts of the investment spectrum that change dynamically, this is all still the same. When you go to work at a company, the blocking and tackling that needs to be done hasn't changed dramatically.
So I want to, so Howard, just 1 second, because I want to balance this a little bit. Remember I said, stay on one side or the other side. So they're both talking about the really complicated, messy stuff. Look out the window. I don't know do you see like American corporations going bankrupt one after the other? I don't. Okay. This is not 2008. This is not, thing. So we were talking about maybe.
Well, I think to Ron Lee's point earlier about the companies that are driving the market are young companies.
I said the haves and haves nots.
Right.
So wait, let's talk about the haves for 1 second, because the world hasn't come to an end yet. So I told you in 2017, we had a huge position in CLO triple B. So forget that part. What's the asset inside? Is a senior secured floating rate corporate loan. Okay. That's what the portfolios are made of. By the way, we're doing it again today with family offices and a SPV. The point being is that if you take Dell Corporation or whatever, they are not going to default on their senior secured loan unless they're going bankrupt. So the default rate's 1% right now, which is below the historical rate. But even take a bankruptcy, Dell Airlines, they went bankrupt, was it 12 years ago, 15, whatever it was. So Delta, sorry. Boy, that was mixing things up. So Delta Airlines goes bankrupt. They don't pay the pilots. They don't pay this. They don't pay that. I knew the pension fund. They were like, oh, we're pension funds. We have more assets than the company does. They pay their senior secured floating rate loans. Otherwise, Delta Airlines would be wiped out. The equity would be gone. They paid them. So that's why the default. So I'm talking about the haves. So the haves, if you go to Apple, their senior secured loans don't bother you unless you want to make 1% or less. But in the middle, those really good companies, U.S. corporations, don't pick the ones that are in auto parts, whatever. It's not that complicated. And CLOs are just structures that own these portfolios. So get me on the side if you want me to explain it, because I don't want to waste time. My point is, those companies are not going to be on the list of things that these guys are interested in.
No, because we're underwriting to a higher return than you can get there.
I agree. Well, the CLO structure gives you the higher return, but that's taking more risk. But anyway, I don't want to
That's the whole leverage issue.
I don't want to. It's. By the way, no, CLOs are unlevered. By the way, they're unlevered. So I just wanted to separate that. I said don't go down Main Street, but there isn't just all the messy stuff to go investing, because it is complicated. But you can balance that with things with decent return. By the way, I'll end it. Last year, senior secured loans returned exactly the same thing as high yield. High yield defaults go through the roof. The recovery rate's 20%. That same investment default rates are 1%, and the recovery rate's 80%. So I'm just giving you guys a universe to think about, not just really interesting stuff.
We have a
to
question.
the question.
Yeah.
So we're talking about, things that don't necessarily make you popular. You talk about it at a country club. You want to have a friend, have a dog or whatever it is. But
If I can give you one. You want to brag?
So I have a question about this. I have a question about this equity dressed in debt dressed in drag, equity dressed in drag. this like loan to own stuff. And I guess what I'm wondering is, because I spent just a little bit of time in this credit world, so it's really just coming from a place of curiosity. And you talk about the world not falling apart, but you know, you have businesses, farms, or whatever it is, businesses that are in distress. Is there a reputational risk within the industry of kind of throwing a lifeline when you know that they're not going to make it, and you get to take the company into equity, or maybe you don't talk about the country club, but is there a kind of reputational risk within the industry itself?
I would say yes, but I would say also I don't know that if it matters. If you know, like when we are working with a company and trying to buy the fulcrum security, we come from a place of wanting to see them succeed and working with them. There are a lot of people who will throw a lifeline hoping that things go kerflooey and they just sell off the assets and break up the company and they make their money that way. So I think you have to understand the strategy.
And it can be deep. It can be deeply depressing to watch as well, because you'll see this company, it'll come in, the first set of loans will come in, there'll be another set of loans, there'll be some weird restructuring of the cap table, and then some more money will come in, and then PIK interest will start coming in. And then it's like, okay, when is this going to happen? And then 90 days later, 91 days later, boom, chapter 11. Oh, here you go, Judge. Here's this wonderful plan that will save the company. And this is what and it's just like,
well, it's vulture. It's what's called vulture investing.
Reputation.
Where?
Behind the
Brian?
Oh,
Yeah, really great panel. Thank you so much. You actually make me look optimistic and happy. So I want to thank you for that, first of all. Also, slight clarification just before I ask the question. I'm pretty sure there was no non-economic nefarious activity in The Big Short. I'm just saying, like, I think it was Wolf of Wall Street, right? Rather than The Big Short. But
already it happened.
So moving on
no,
to
but
the
he
question.
said you were conflating the movies. It was more Wolf of Wall Street with the hookers and the.
Yes, excellently said. Okay, so to the question, I would have.
Although we were invested with the guy in California, the guy who's kind of
swaps that Burry did for like 3
yeah, Burry. I was invested with him. I think it was one of the weirdest meetings I've ever had in my life.
And I'm too young for these. So I only started in 2009.
So this is my question. After I remember Silicon Valley Bank, like the day as I sat there and we're way over leveraged in Silicon Valley Bank on that day. It seems like since that day, all banks have stopped being banks. Like there is
100%.
no banking anymore.
That's what I was alluding to before, is the traditional lenders.
Let me just, if I can just finish the question, right? So the thing is, with banks leveraging at like 20, 25%, they don't exist anymore, which means we have the lowest interest of all times. We have credit facilities who can charge whatever they want to. There's no equity. There's no banking lending. I would have thought this is like the greatest of all times for being able to get amazing margins on credit. Like I get the distress stuff, but I mean, for the great stuff, this is the greatest of all times for you.
So Silicon. Wait, let's talk about two different things, please. What you're talking about hasn't existed since 2008. Banks all had to have super high asset coverage, stress test, whatever. Silicon Valley Bank and one other was an anomaly. It was an anomaly of zero rates. What happened there should never have happened, in the sense that venture funds who had raised a round left their money, cash, sitting in a bank earning zero because there was no place to put it. Okay. So that is an anomaly. And I ran 3 venture funds, by the way, never left our cash sitting in a savings account. Okay. The other side that you're saying about banks is, so the other banks that were caught were all in commercial lending, which is a normal activity for banks. And it just, the whole underlying asset class crashed.
But I think
But the rest of them aren't dying. They're just not allowed to go out and be creative anymore.
right. What I was going to say is Silicon Valley Bank was the tip of the iceberg. These other banks, well, and First Republic, right? 2 banks. But it was the tip of the iceberg that caused everyone else to pull back from the markets, which was the point I made before, of traditional sources of funds, particularly for these mid-cap and small-cap companies, aren't there unless they go to the private credit markets.
I think commercial real estate was a much bigger impact in Silicon Valley.
I think your point though on the great time to borrow side, yeah, if you're a have, it's a great time to borrow. as we've been discussing, there's vast amounts of you want to borrow 100 million and you're a good solid company with great returns and some good asset base. Throw a rock in this town, someone will lend you the money. Throw a rock, someone will lend you the money. That is relatively tight, and they are all chasing relatively few deals. And quite what that paperwork will look like when everything comes full circle, I don't know. But yeah, if you're a have, great place to be. But those requirements are quite tight.
But if you're a have, it's because you may have cash or you've got, enough cash flow or enough earnings. I mean, and the problem too that exists is the have-nots are already pretty levered, right? Because let's just think about small cap. Take one example, small cap companies that are private equity backed, right? Those private equity sponsors have levered them up, even if they didn't need the money, dividended those dollars out to their underlying investors. And so you've got companies left with more debt than they needed that's now more expensive because a lot of it was floating rate, or it's coming due and they have to
5% now.
refi.
So I have a question that has been on my mind a lot, and we talked about real estate investing and what a great place for it to be.
Lending, not investing.
Lending. So there's an election coming up in November that potentially can transform this city, and I'm wondering how you think the potential of Mondami being elected can affect real estate here in New York, and if that could have a broader effect on the markets.
So let me say this. I'm terrified of Mondami for a whole host of reasons, not the least of which I'm a Jew. But, New York is still New York, and it will always be New York. And anecdotally, my stepmother had lunch a month and a half ago with Mike Bloomberg and his partner, Diana. And, Mike said the good news is Hochul will keep him under control, and there's not a lot he can actually really do. So New York will always be New York. People will want to do business in New York. Is it going to cause some people to leave New York? 100%, at least for some period of time. And if it, feels like it becomes a lot less business friendly, but we've seen this movie before, right? So yes, do I think New York is going to have some pain? Do I wish I had sold my apartment 4 years ago? If I'd had a crystal ball, I do, but I didn't. And I'm certainly not going to sell it now. But we already post-COVID haven't come back to occupancy rates that we,
Full. 100%.
Office buildings are not full
No,
now.
I'm talking about residential.
Oh, no.
You said your apartment.
No. Well, my apartment, but no, let me say this. The residential real estate in New York is complicated, right? Co-ops, condos, and rentals.
Same.
Rentals are through the roof because nobody wants to own.
Or can afford
They
it.
can't buy anything. They can't afford to buy. Don't.
That's my point. That's why I can't sell.
Don't want to own. They are very different things.
The short answer on real estate, no politics, I'm Jewish too, don't care, whatever, is
I care.
No, I care, but
I don't care that you're
Jewish.
Jewish.
I'm talking about real estate. I'm trying
Thank you.
trying to talk about real estate and not too many other things at once. So the answer is in what Suzanne said, very little is going to change. The mayor does not have the power to upend the entire real estate market of New York City, and they don't.
But it's going to feel uncomfortable because
might feel
business
bad.
leaders are going to talk about how it's
Don't watch
anti-business.
too many headlines because it if it all screws up, it'll be gone before anything happens because that's what happens with politicians. So the short answer to Howard's question is very little.
And like I said, New York is still New York. People want to come here. People want to do business here. There's as many. I can't remember what the statistic Kevin Ryan gives about, the technology companies being founded in New York versus Silicon Valley, and the kids that go to Stanford and, they're not staying in Silicon Valley anymore. They're coming to New York, and there's not a lot of competition from other cities for innovation. So, does big business leave? But I don't, innovators who.
I mean, at the end of the day, the two fastest growing states are Texas and Florida, and that is not a trend that looks like it's slowing anytime soon.
Well, there was a guy earlier today that said that there's an independent candidate in California saying zero taxes.
I think it was
It's you.
Brian. I'm uplifting Irishman. I mean, New York real estate's always been its own basket case of crazy. Speaking as someone coming in from another country, and as my view on New York real estate is, if you're in the biz and that's what you do, then great. And if you're not, like, don't know. This is a nice big country and great plains and beautiful mountains and many places that aren't New York City that you can invest in that are significantly less stressful.
So I asked Marty for another 45 minutes and he said no. So what I would like is just a minute or two from each one of you to wrap up what your thoughts on this conversation was. And I'm sorry I didn't get to all the questions I wanted to ask you.
We're not.
Yeah, I'll go last, or I went
You
first
can
in the
wrap up.
beginning.
You can
No,
wrap
go ahead.
Okay. Yeah. So I'll leave you with a thought about stuff that is something you can talk about and brag about at the country club, which is opportunistic credit, which has always been a fun thing. It's always been a sort of fun hobby of mine rather than like deep investment strategy. So we're currently in a trade company in Brazil, and the consensus is it's going to go bust. We're basically doing a geopolitical thing, which is the Brazilian government, is the Brazilians going to let this company, is it going to let this company go bust such that the senior debt's not going to be paid? And we think probably not. Now, is this?
But that's a very different
Oh no,
play than investing in credit.
totally different. Completely agree with you. This is simply, and I like geopolitics, and I like plays around geopolitics occasionally with a small amount of what we invest in. Not this is like our core. But if you're into geopolitics, if that's an area that interests you, if that's an area that you want to take, you think you have knowledge you want to leverage, there are interesting plays in the credit world. The credit world is often your friend in that kind of play because the equity will often remain undervalued for a very prolonged time, whereas the debt will always continue to pay out. So even if you've bought it at, 20 points below par, even if it never actually recovers until like 1 month before the renewal, you don't care. You've actually made good on your interest rate. So that's an area I quite like. It's quite fun. So I'll leave that there as like a fun note for family offices.
I would just say the one thing that, and I love Brazil, and my daughter speaks fluent Portuguese, and I've spent a lot of time there. The government is unbelievably corrupt, and they can change their minds on a dime. So I would find that a very hard thing to invest in, as much as I'm a Brazilo-phile or whatever you would call it.
My venture capital fund and officer for 5 years, but I'm not talking about Brazil. Anyway, so one advantage you have in credit, by the way, this is a great time for credit. Very simple. Walmart stock gets cut in half tomorrow because somebody puts a tariff on them. Their debt isn't going to move. Not going to move. You're going to get paid. Don't worry about it. Okay. So on one side, there are super solid borrowers, and normalizing rates means you get paid a lot more today than you did 7, 8 years ago to lend to the same quality of credit. On the flip side, there are some really messy things that we've touched on here. 12 years ago, there was zero venture lending. You didn't lend to venture-backed companies. Went through the roof. 85% of venture-backed companies have less than 1 year working capital, and I'll send you the chart of debt.
And
It's
no
absurd.
IPO market.
And no IPO market. That's the statistic. Pick it, whatever. You're going to end up owning the company if you own the debt, and you better want it. So commercial real estate, Suzanne talked about it. Joel had some very specific things. So if you want to get your hands dirty and get really interested, there are smart people in the world that can take advantage of dislocations. So you have both those opportunities to work from, is my
Yeah, and I think that's where the money's going to be made. I mean, that's why we're excited to raise a new fund, right? We've been on the sidelines for over a decade waiting for the opportunities to happen. And I think there's going to be more on, in mid to smaller cap companies, because they are definitively the have-nots. And that's where bigger dollars are going to be made. And I don't disagree with what Andy's saying about being up the cap stack, except if we get 4 cuts over the next 18 months, which is the market's betting, right? They're saying there's one,
Talk about inflation or cuts?
no, rate cuts.
Yeah, but-
they're talking, if we get
Without inflation.
rate cuts, we have a lot of inflation.
We have the same as we had.
I totally disagree. I don't
Are
know
we,
if
is this
inflation-
closing statements?
Yes. Anyway,
TikTok.
I do think there's inflation. And anyway, that's my closing statement. I think what we do is super interesting. I'll talk my own, our own book. I think it's a really interesting place to be. And I'll reiterate that I also like real estate lending with someone who has a relatively clean balance sheet. I don't want to buy into something with legacy loans unless I think there's a workout specialist there, because then it can be more interesting. But it's, again, they're specialized skills.
All right. So I
Fantastic.
get the last word, which is thank you very much. It was a great panel, and thank you, everybody.
Great job, guys.